Okay. Welcome back, everyone, to another week of the Kingscrowd Investment Roundtable. My name's Brian. I'm joined by our senior investment associates at Kingscrowd, the very knowledgeable and amazing Teddy and Leia. Today, we're going to be talking about something that is critical for all investors when you're looking to invest in any startup investment opportunities, any investment opportunities online on some of these funding platforms. That is, what are some red flags and yellow flags as an investor that you should be looking out for? Now, Leia put together a chart for this week that was our chart of the week, which showed a breakdown of what some of those top red flags and yellow flags are. We're going to be reviewing each of those, talking about some of the reasons why it's actually a red or a yellow flag that investors should look out for. And also, we'll just be explaining a little bit about more why it is a flag and something that should be a risk area or something that an investor should want to dig into. I'm going to pull up real quick the example page on Kingscrowd to show you where you can find these. If you are a paying Edge subscriber to Kingscrowd, deal considerations on the right-hand side, and we show them under key challenges and other risks. So you can see this is just a sample company that I pulled up here, but some of the different key areas for key challenges, which we kind of consider red flags, are low runway, they have active or past lawsuits, and high revenue multiples. So we're going to be talking about what each of those means today. In addition, in terms of other risk areas, we determine these and kind of consider these to be more of a yellow flag, a caution, not as important necessarily or as much of a red flag as a key challenge. But the insiders were selling shares in this particular round. In this case, they were selling 9% of shares, and also unclear valuation, one of Teddy's favorites that we're going to be talking about here. So I'm going to hand things over to Leia. Leia, you put together the chart for this week. Why don't you tell us a little bit about what you saw?
Yes, it was very exciting to finally be able to get the look back at 2024 and see what are the mistakes, problems that are the most commonly happening into runs. And so the number one that was not really a surprise for us, unfortunately, is related to low runway. And that's a big problem because when a company has less than 6 months of runway when they start their raise, it means that they may actually run out of money before they finish their raise if they don't raise enough funding. You also need to be able to look at how much money are they burning each month and kind of do the math in your head. For example, if a company is burning about $50,000 a month and they only raise $200,000 by the time you're investing, it means it's only adding them 4 months of runway, and that's not really going to help them grow. So this red flag is very important. It's unfortunately on 37% of the deals. And so as an investor, you have to be very careful because it adds a high risk of bankruptcy. What I will be doing if I were an investor wanting to invest into a company with a low runway is that I will go in the discussion section and just ask the founder, what are your strategies to raise funding if you don't reach your masks or if you only, kind of reach a certain lower threshold, and kind of see what founders are telling you. Most of the cases, unfortunately, they don't always have a backup, but some of them are talking to VCs, institutional investors. Some of them have personal wealth that they can help to sustain the company until the company is in a better place and they can raise more money. So that's definitely one of the things that you want to look at.
Yeah, I'm going to pull it up on the raise page. So this is actually something that's available on any company page. If you come down to the financials section, as long as we have the latest cash on hand and the burn rate. And you can see here, we show the monthly burn, their revenue, and then we also know their cash on hand based on their prior year financials or the most provided. We automatically calculate the runway. So while it's something that will be called out in the checklist in terms of a red flag, you can also see what that number is here. Now, to play a little bit of devil's advocate here, but given that a lot of companies that are going to be raising on these platforms are looking to raise capital to get to the next step, when is that really a concern in terms of when you're looking at this of like, should we be worried that they only have 3 months? Or, a lot of times do we actually see that be okay in other situations?
Well, of course, if they're raising a lot of money on the current raise, you don't have to be that much worried. But for me, it's kind of a planning problem right here. Do I want to invest in a founder that is going to wait so long until they start raising money? Of course, it's kind of difficult to ask a company to have more than, let's say, 12 months of runway. That's way too much. It means they're not spending the money. But I feel like you should at least have it somewhere between 6 and 10, 11 months when you start raising online, especially because these rounds not only take time, but they're so uncertain. Especially if it's the first time you're raising on equity crowdfunding, you have no idea how you're going to perform. So you should always have a backup plan. And in order to have a backup plan, you need to have enough time.
Yeah, another thing to keep in mind with burn is a lot of companies, they are raising so that they can inject more money into marketing or product development, whatever it is that. So a lot of these companies, they're planning on actually increasing their burn after the raise. So even if they raise, let's say they have 6 months of runway and then they raise an amount that would theoretically get them to 12, like they're probably going to increase their burn. It's probably going to go back down to 6. Because as a high growth startup, you want to invest it in growing as fast as possible. So yeah, just something to keep in mind. Most founders, if you ask in the Q&A, they will give you information about that, like use of funds and is that going to increase their burn and things like that. So just something to keep in mind as you're looking at those figures that are historical burn rates, but kind of looking into the future and how that might change.
The second highest deal consideration red flag that we have here is the shareholder share sale. So, to give a little bit of context, it represents 36% of the companies that are raising through Reg A Plus, because this simply does not apply for Reg CF. So, among all the 857 raises that we've seen, it's something around, I think, 8 or 9 raises. So, that's a very low number overall, but among Reg A, it's actually happening a lot. So what does that mean? It means that shareholders that have previously invested in a company, or founders or employees, are selling their shares during the current round. So as an investor, you're not only going to be buying shares that are newly issued by the company, you're also going to buy shares back from somebody who used to hold them. The main risk here, the main kind of issue, at least for me, is that the money you're investing is not going to go fuel the growth of the company. It's going to basically pay out a founder, an employee, or an early investor. And while it's good for companies that have been going on for a very long time, that are pretty successful, I feel like at a certain amount, it's really going to prevent the company from growing. And it can actually limit the future results of the company, because we know that a company needs to fuel its growth with new capital.
Yeah, I'd like to throw in a thought too. So there's the obviously tangible benefits when you take capital that would be going to the company and it's going to the founders otherwise. As you mentioned, that can detract from growth. I also look at it, and obviously there's a spectrum of this, right? Because founders need to get paid, and a lot of times when a company starts, when in the very early days, they don't have a lot of cash. So the founder will take a very low salary, often get paid more in equity. And typically it will reach that tipping point where it may get to the point where the company's doing better now, where the founder wants to take either a little bit off the table, or the investors want to be able to give that founder some cash so that they can focus 100% on building this company, right? They don't want them to have to worry about whether it's daycare for their children or doing the laundry or house cleaners or anything like that. They want all of those expenses to be taken care of. Now, where it can get pushed to the extreme, right, is think about as a investor looking at these companies, these founders and inside shareholders. It's not just the founders; it could be sometimes existing employees or earlier investors. If they're selling shares, why would they be selling shares if they think that this company is going to be worth $1 billion or a lot more in the future, right? Because they're really giving up a lot of gains there. So it can be a bit of a negative signal for me if there's too much being sold, where it could become a little bit more of, are they looking for basically exit liquidity? Are they just looking to get out of this deal and get paid because they're not sure about the future? Or is that going to demotivate them as the founding team, as some of these early investors? Why are they doing that? So none of these questions are easy to answer because a lot of these things aren't going to be publicly shared, but it's questions and different things to be looking into when you're kind of considering this.
And that's why we also differentiate the flag being a red flag or a yellow flag based on the amount that is sold. So above 15%, we consider it to be a red flag. Companies like Mod Mobile, Avenir Electric are currently selling 25% of their rounds through insider shareholders. And Start Engine, which has been doing this repeatedly, rave after rave, is selling 20% of its raise through inside shareholders that are selling their shares right now. So we do think that above 50% is a red flag. Below 15%, it's more of a yellow flag. Yes, it can still hinder the growth, but it might make sense. So in this case, like you're showing it, Brian, Miso Robotic is only selling only 8.94 of its share. Now it's up to you as an investor to see whether you're comfortable with that or not.
Yeah, so another one that I always look for, and it can be good or bad or understandable or not understandable, but with full-time founders. So you'll see in some industries like med tech or biopharma where it'll be founded by a practicing physician or a provider where like they have a great full-time job, but they have this startup that they want to try to scale up or maybe get FDA approval, but they still have their full-time job. So in that case, it's kind of understandable. Like they're kind of doing it on the side. But from an investor standpoint, if you're going to invest in a company, you ideally want a founder that's putting all of their time into their startup. And the startups that are really early on where like they have no money and it's like truly just an idea, like that's obviously going to be tough to have a full-time founder on that. And when you're just totally betting on an idea. But especially as companies mature and they have some solid revenue, have some solid funding, you want to see founders that are full-time. So it's definitely something to look out for, and something that we track at Kingscrowd as well.
Yeah, and I'll jump in here for repurchase rights. So this kind of rounds out the top four. So that was found in 30% of the deals. Now, repurchase rights is something that you have to be reading your deal terms in detail to be able to see that. Usually it's generally not something that's called out kind of in the front of the raise page. But if you read through the subscription agreements, it's something that may stand out. And what that means is it's basically giving the company the right to buy out earlier investors. And they'll put terms in there such as the fair market value or, the as a minimum, like the original purchase price, dependent on certain conditions. So sometimes it may be dependent on if the company is worried that they're going to become a Section 12G reporting company. It just means they're going to have too many people on their cap table where they'd have to have a lot more costs and more disclosures. So it allows them to buy out earlier investors. It used to be something that was pretty rare and typically only came with safes, but I've actually also seen it, and we've seen it on even some common equity deals. And now repurchase rights tend to be in almost all WeFunder subscription agreements because of the SPV agreement. So what that means, and I will say that, of all of the repurchase rights, WeFunders is more fair because they have some extra terms in there about it can only happen under certain conditions. And also it has to happen only with the approval of the WeFunder SPV admin. But where I've seen repurchase rights go wrong in the past is some companies that could be doing very, very well, and they're looking to bring in a new venture capitalist who's going to, raise a huge Series A or Series B. They don't want all the smaller retail investors on the cap table. They want to clean it up. So they will buy them out. And then I've seen, unfortunately, some people basically do their fair market valuation at certain times where it looked lower than it probably actually was, as it should have been. And so they get bought out for not what the actual value is. Now, the real downside of that is that those investors are going to miss out on all the future appreciation. So typically, a lot of the companies that are going to be doing this are only going to be doing it if they're doing well, right? You're not going to buy out earlier investors if you're doing bad. So if anything, it's kind of a misalignment of incentives between the founders and between investors. Now, all that being said, it's not, we don't see it as much in, some of the other agreements that we used to. And the WeFunder one is at least more well-structured, I will say, than some of the ones that give the company anytime, any reason they can buy out early investors. Those are the ones to steer clear of.
The next one that comes down the list, I think, is Teddy's favorite, unclear valuation, which represents about 14% of the equity deal. So same thing here. We kind of took a different pool because this doesn't really count for uncapped, for safe and convertible note. They have their own red flag when they're uncapped. Teddy, please, I'll give you the honor to explain to us what that is and why is this a problem.
Yeah, so this is one you see more on Reg A than anything else, where a company will not put their valuation at the top of the raise page the way that we typically see on sites like WeFunder or Start Engine or Republic, they tend to happen more on like the deal maker, the DAO more, where the founder has a bit more control over how the raise page is presented. And it basically require to actually figure out the valuation of the company. You have to go into their offering circular and figure out the total outstanding shares on like a fully diluted basis. So that's inclusive of warrants and stock options and all that. So it can get pretty complicated pretty quickly. And a lot of the time when we do calculate them and then we eventually get in contact with the founder and then we can kind of see the math play out in a bit more detail, like the valuation will be different than what we initially calculated. So it's kind of just a super muddled area and something that I think is like a huge disservice to investors, especially ones that might be newer to the space and not as familiar with how shares outstanding might work or how to like look through or where to look in the offering circular for this information. So this is like probably my number one red flag in terms of something that like really turns me off immediately to a company. So I am praying that something is done at some point in this industry to fix this because it's tough.
When you
It's
said
tough
that
to
this
say.
happens a lot in reggae, you're right. It happened in about, we had like 22 reggae in the pool of companies we use. It happened in 13 of them. So that's more than half. Of course, by number, it happens mostly in Rexia because Rexia, we had what, more than 800 of them. But as you say, it's very specific on some platforms. It can be a big problem for investors because you have no idea what valuation you're investing in, and therefore you can't really calculate or estimate what's going to be your return. And some cases it's very close. In a lot of cases, we can calculate it at couple millions close to the real valuation, but sometimes we have difference between millions and billions, and that's a big problem.
Yeah.
Yeah. So some of the last ones on the list are pretty self-explanatory. We had, loss of 50% of revenues in 1 year. So if revenue is going down, if it's a down round, which means a decrease in valuation, lawsuits, if there's active lawsuits, and then uncapped safe or convertible notes. Are there any of those that you want to dive into, Leia, in terms of any that really stand out for you?
Well, one that really stands out is the outrageous revenue multiple because it's a chronic problem that we have in the industry. So I feel like we were very generous actually because what we call outrageous is over 75x of revenue to valuation multiple, which is just way too much. And so we actually are going to lower that bar from now on down to 25x because we feel like 25x is already way too much. Now, it's also a way to inform investors. So, you can look at it, see if you feel comfortable investing in that company or not, but you should be able to know what is that multiple. The problem is that so we see here on the chart, it's 11% of all the deals that we looked at, but it's actually 18% of all the post revenue deals. That means that 1 in 5 companies has this outrageous valuation and they're just not taking investors into account. And so while we know that one of the good things about democratizing access to raising money online to everybody without having to go through VC is that founders have some more ownership. Maybe they have valuations that are more fair to them. But the downside is that maybe it's not fair anymore to the investors. And so it's something that you really will have to look at. I personally have found a lot of deals that I love, but I've just passed on because of that valuation. So as a founder, you have to be careful because that can hurt you.
Yeah, I think value, there are some really good quotes on value from a bunch of different investors, right? But think of it that not every good company is a good investment opportunity, right? You could have a great company, but at the wrong deal terms, the wrong valuation, if it's overvalued, as an investor, you need to ask, how am I going to make money on this? And it unfortunately just prohibits that. So even if it's a great company, it doesn't necessarily mean that it's always a great investment opportunity. Now, flip side of that, right? You could have some companies that are pretty mediocre, not great, but at the right price might actually be a pretty good investment opportunity. And that's why looking at value and things like valuation and everything else that goes into that is so important.
You also have to consider the industry that they're in. I mean, there are obviously some revenue multiples that are just like outrageous for any industry, but like if it's a CPG company, like where it's an alcohol company or any type of consumer good, that if you look at public revenue multiples, so public companies, like those tend to be much lower than, say, a really high growth AI company that's going to be demanding 25, 30, 40x revenue. So of course, like at a certain point, it's just too high for any industry, but it's also something to just take into account. And I believe that is something we track at Kingscrowd on the front end of kind of, is it high relative to the industry that the company's in.
All right. Well, I think we are pretty good for the day. There's obviously a lot that we could say on the topic of red flags and yellow flags, and we'll be covering that more in future investment roundtables. But thank you everyone for joining us. As a reminder, to get a lot of these great data-driven insights, go over and sign up at pitchreviews.com to be able to get all of these newsletters directly to your inbox. Also, feel free to check out Kingscrowd so you can look at our deal considerations checklist and get all of these red flags and yellow flags whenever you're assessing new investments. Thank you, and we'll see you all back here next week.